Hey, Sam Livingston here. Wanted to do a quick video because I've had quite a few questions regarding pre-approvals and where where things have happened now is I was working with buyers that couldn't necessarily find the right house. We have a strong market shortage here in Northeast Ohio. So it's been 6 months, 8 months, maybe 9 or 10 months even for some of our buyers out here since they got pre-qualified and have a pre-approval. So what's happening now is, as they come into the market, their affordability has changed. Where people could maybe afford a $350,000 house before, nothing has changed on their side, but now they're finding out maybe they can only afford 320 or 300 or whatever. And I want to talk about why. And so the first thing that's probably the most important thing to discuss is how a lender qualifies you. And I'm not talking about credit scores and things of that nature, but they will look at those credit scores. They'll look at your job history. They're going to understand your debt to income ratio and things of that nature. But the thing that is really going to be common across the board is where the interest rates are. So a lot of buyers think that that lender is going to pre-qualify them based on a house or give them that value and work backwards. And that's not true. What they're really looking for is what the PITI that buyer can afford. So that's the principal, interest, taxes, and the insurance. And that's going to be a monthly cost. And they're going to put that into their equation so they can find out what the debt to income ratio is, and then what percentage that will fall in will kind of read into the calculation for that lender to be able to determine what the monthly payment they can afford, all four of those things being considered. So here's what we know. So the PITI is principal, interest, taxes, and insurance. And I think most people are pretty familiar with these things, but principal, that's going to be the basis of the loan. That's how much you borrow. And the interest is going to be the cost of borrowing that money. So that lender is going to basically have a charge for you to use their money. Taxes and insurance. And here's where I like to start. So we have taxes, and we have our insurance, and they're usually depending on where you live, the taxes could be all the way out here. But the nice thing about taxes and insurance is they're going to be relatively stable. They're not going to change too much outside of a specific neighborhood because those home values should be somewhat reflective of one another. So we have our insurance, and that's your homeowner's insurance. Any mortgage property is going to have it. Any property should have it. And then our taxes. So these aren't really variable. So what you have left in your monthly affordability, and I have a great graph. We're going to go into another video after this, and I'm going to show exact examples. But what we have left of that PITI monthly affordable payment is going to be two things, and one is going to be the principal, and the other is going to be our interest or our costs. So the way mortgages work is they're front-loaded interest. So the beginning payment is usually, unless we have very low interest rates, going to be higher than the principal. And as we make payments each month, the interest should go down a little bit and the principal should go up because the overall payment is going to remain the same. So what happens when interest rates go up is they start to eat into this leftover pie and leave you for less borrowing power. So interest rates being at 2.5% or even less than that maybe a year ago have crept up, and we're a little bit over 3% today prime. I'm not a mortgage broker. I'm not a lender. So I'm not trying to give you advice about where your rate should be. I'm not quoting rates. What I'm saying is when the rates go up, your affordability goes down. So this is your principal mortgaged amount. This doesn't matter if it's FHA, if it's VA, if it's conventional. Any mortgage is going to have certain parameters that you're going to be able to borrow. But what I'm talking about is this is the monthly payment that we're going to have affordability on. And that determination by the lender is going to say your monthly payment, let's say it was $1,700. Well, you're going to take out the insurance from that and the taxes from that. And let's say that could bring you down to, let's say about $1,300 a month for the monthly payment. Well, obviously, if the interest reaches a higher portion of that, then the principal is going to be driven down. So that's how it correlates. So I'm going to do a video here in a few minutes to show exact examples, and I have it from 3% to 4% to 5% based on the rate, and show you exactly what it means in your buying power. And again, this is because I have buyers coming back to me now that maybe have been out of the looking game or the searching for a house game for several months, and interest rates have changed enough to where their affordability has gone down. So stay tuned for that, and if you have any comments, please throw them below if you have questions. I'd love to answer those. And of course, everybody will be able to link this back. I'm going to put it on LinkedIn. I'm going to have it on YouTube and a few other places. So if you have questions, there'll be easy ways for you to reach out. Thanks.